Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're doing another quick little video. You already know what I'm going to say, looking at the numbers here. But I saw RCAT Holdings, ticker RCAT, come across my feed. There are members of Congress buying it. So I wanted to take a look and see what was going on with this one. And they break the number one rule. They have negative earnings. So in my book, it's not an investment that I'm willing to make. But we can dig into the numbers and see what's going on with them, why it's on a decent run since those earnings, or why it's on a decent run since since Congress started investing in it. So they're probably getting government contracts, but the issue is just their spending is completely out of control. They make decent revenue. Revenue is growing very quickly. 50% is what we're using for the thesis. It might even be more, to be honest. They're starting with a really small number, so they can grow it pretty quick. But they have negative earnings. They're not expected to have positive earnings anytime soon. And it might be 3 to 5 years before we see any positive earnings out of them. Cash flows are negative. ROE, ROI, ROA are all negative. Debt to equity is decent, so they have a decent balance sheet. They do have room to take on debt if they need to. Gross margin, pretty low, 20.64%. We like to see that 30 or above. On average, 9.6. So they are getting better. Net margins, negative 135%. On average, negative 297%. Getting better, nowhere near where we need it to be. So it might be in a better place in 2-3 years, but I don't like where it's sitting right now. This is just an anticipation and assuming that they continue growth. It'd definitely be a growth stock is what I would consider it to be. It's been as low as 56 cents in the last 52 weeks, currently sitting at $8.82, but it's been as high as $15.27. So it's pulling back. The pump and dump has happened, clearly, and I think people are realizing that it's not as great as it's cooked up to be. So revenue, we're coming in with 50% for our thesis. It's higher than the 1 year, but significantly lower than the 2 year. Share count, they continue to issue shares. It is slowing down, so hopefully they continue to slow it down. 9%, I feel, would be a fair estimate here. But that's something where 9% of your equity is just being taken away every single year as they issue more shares to more shareholders and ideally use that cash to further the business, but they're really in need of cutting their spending instead of giving a reason for it to continue. Cash flows have been negative, so I have to put a negative number in here. And ideally, we're looking for it to grow where we're sitting close to positive in the next 5 years. I mean, they are at a very bad point right now with their cash flows. So it's probably going to take a lot. Definitely not going to get to the double digits that we like to see anytime soon. Assets, I mean, they had some decent asset growth 3 years ago, sold off a lot in the last 2 years, but hopefully they can continue to grow the assets as they grow the business. Liabilities, right around that negative 10%, so they are paying off the debt. No dividend. Margin, we'd like to see that get closer to zero. It's really tough when these companies have negative numbers. I mean, it's already a disqualifier, but they got to grow their margins at 75% a year to get to essentially zero in the next 5 years. And with that thesis, you're looking at really good growth rates, 19.56%, twice the market returns. Unless they're actually showing earnings and cash flow, it doesn't matter. It's just a company losing money. The number is becoming less negative. So we can take a very quick look at the trends, and then that'll be all for this one. So the green down here, cash flows took a big dip. It's on the way back up, but continuously negative. At no point has it been positive. And then in orange here, we have the fair value. So it's flirting with zero. It's an essentially worthless company. At 56 cents, honestly, might not be a bad price to get into it if you think that there's a future to it, because it does have some decent growth potential. It's getting government contracts, could be good in the long term, but right now it's not. I think that I'd be willing to throw $50 down on 100 shares of something that in the future could give me a 20% growth rate. Right now, it's not worth too much. And then in the red here, we have earnings. So they had some decent earnings a few years back and declined. And then in the dark blue, we have the share price. And the balance sheet seems to move pretty close with the share price up until this year. Share price honestly was not at a bad spot this last year. I mean, significantly more than it is. You get a cluster of values here. Cash flows, honestly, the most important thing for a company, kind of dragging everything down. But just looking at this, I don't think that the share price was too bad. And then right now, it's insane. It's definitely not worth what people are paying for it. And well, they're already starting to find out. You saw how high it peaked and how it's already cut in half so far. It'll probably come back down to like $5 and settle there, because that'll be another support point. But that is what we're looking at for this one. So, I mean, that's why we look into companies and we don't just follow the hype, because it had a nice push. 56 cents to $15.27. Some people made a lot of money off that. And the smart ones sold out. And the ones who weren't smart are still holding on or are buying right now. But we'll see what happens. If it drops down below $1, honestly, for what we're looking at here, it might be worth throwing some money in on. So I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay updated with everything. I'll catch you next time.